in days or in the matter of weeks. It's not going to be months. And so what we have, the setup that we have for this week is we have the Fed that is in the blackout period before the FOMC meeting next week. So this might actually be a positive for the markets. At the same time, we do have an important week of earnings, a huge week of earnings, but that also means that some of the corporations are going to report earnings and be out of their blackout windows. So they might be able to step into the market and support these stocks. So that kind of argues, and by the way, the sentiment is terrible. So that kind of argues to me that maybe we are poised for a tradable bottom. But the problem is you take a step back, and I have a lot of question marks about a consumer-led slowdown and what this means for earnings. And by the way, not just the cyclical stocks that are pulling back, but actually what this means for earnings of the big tech companies as well. I mean, if you look at the commentary that was out on the weekend previewing earnings for a lot of the big tech names, they're not all that positive. They're talking about slowing down in advertising spending. They're talking about a challenging smartphone market backdrop and a number of other sectors that are decelerating, even in the big tech. So it might just not be all that immune. So I think that's a big question mark for this week. Depending on how these big tech earnings shake out, that will determine whether this bottom holds here in the meantime or not.
All right, so Joe, Mike Wilson, Morgan Stanley says it's harder to hide as the bear gets grizzly. Lori Calvasina, RBC, cuts the year-end S&P target. Still looking for modest gains, but nonetheless, she takes the target from 50.50 to 48.60. Jonathan Krinsky suggests that the leaders are finally succumbing, and that suggests you're in the later innings of the correction, but still looking for sub 4,000 on the S&P. You see where we are today. We're at 42.29 as I read that number to you. It's a loss of 1% today. What do you think?
So you go back to the February 24th low, and that takes you exactly down 14.6% for the S&P 500. I have bad news for the bears, and I have bad news for the bulls. The bad news for the bears: you go down, you test that low, you break below it, can totally happen. I'm on board with that. I don't think you're going to get another 5 to 10% from there. You're not going to go down 20, 25%. The evidence doesn't suggest that. Bad news for the bulls. You know I rely on statistics. I told you at the beginning of this month, if you go back and study presidential cycles, this is the worst quarter right now, April 1st through June 30th. In addition to that, over the weekend, I have every correction in my hand since 1966. I did a study for Virtus Investment Partners. Time is the enemy right now of the market. And 2022 is tracing out from a price patterning perspective the same as 2016. Guess what that means? That means you need to get through the May Federal Reserve meeting and the June Federal Reserve meeting. And finally, when you get to the end of June, you've got the potential for the market to appreciate from that point. Until then, it's all about mitigating risk. It's all about not losing a lot of money. And it's all about the market going to a lot of different places and ending up in the same spot.
I mean, I'm looking at Jim. I told you I was going to read something that was going to make you unhappy. It's Cleveland Cliffs is down another 9%, right? So we've got China to worry about, slowdown there. We got lockdowns there. Who knows at what direction those are going to take. You've got slowdown fears everywhere, which is why you have a flight to safety today and why yields are falling. And about the only thing that looks like it's doing anything positive today is the ARC. Is they're getting on the ARC because that's up about 2% with rates coming down.
Scott, do you think I expect you to say something positive to me?
I mean, if there was something positive to say, I would certainly say it. It's not like I'm
good. Let me help you.
Predisposed to find something only negative to say to you.
I am here to be a ray of sunshine in your life. Let's talk about Cleveland Cliffs.
Last time, but you just told me that the sun came out too soon in your neighborhood.
One business day ago, Cleveland Cliffs announced, guided for this year, that they're going to have record free cash flow. Okay, their EBITDA in the trailing 12 months was $6 billion. Their market cap right now is $13 billion. They have a $1 billion share buyback in place. They will increase that if they need to and want to. The management there is incredibly nimble and thoughtful about the right price for their shares. But the point that I'm driving at, and you brought up Cleveland Cliffs, so that's why I'm using it as an example, but it's for the market as a whole, is cash flow is what's going to matter. I have no sympathy for technology shares that were overpriced getting brought low. That is fanboy stocks that nobody did their homework on. When you do your homework on a stock and you get free cash flow that approaches 50% of the market cap, that is what you're supposed to pay attention to and buy. I can't worry about one day's return. This is a stock that if you look at its chart over the last year and a half, 2 years, it has very pronounced up and down cycles. They're short, they're harsh, but the overall upward trend is clear. And with the results from Friday, one business day ago, those trends should continue to the upside. I'm not worried about it at all.
Okay, so let's begin our conversation on what's really riding on this week. And I want to start out with Bryn on that, right? Apple, Google, Microsoft, Amazon, it all kicks off tomorrow, and it's going to be a barn burner. And I just wonder, Bryn, how nervous investors should be that if you're still waiting for that capitulation, if that's what you want to call it, and you don't think it's come yet, that Friday wasn't enough to declare that it was it, whether you're worried that that is the catalyst, if those reports aren't good enough, because those have been so critical and maybe even more so now.
I think Apple's really important because Apple gives you a lens into the most intricate supply chain, I think, in the world, right? So going from China to the U.S. to the rest of the globe. So we're going to get a lens into that. We're also going to get a lens into the global consumer. I mean, in the U.S., like the AT&Ts, the Verizons, the T-Mobiles, they subsidize those $1,000 iPhones. So no one in the U.S. is paying $1,000 if you go to one of those vendors. Globally, you are, though. And so I don't think any of the reports this week are going to be a Netflix or a Facebook where you get really big surprises. I think it's going to be their guidance and the sentiment around how they trade will set the tone for the for the growth stocks, at least for the following week. But I don't think there's going to be big surprises. Google has so much cash. Microsoft, Apple, they are just in different positions than Facebook and Netflix. Those were two idiosyncratic, issues with those companies. And so I'm not worried about the return or lack of earnings with those companies and the effect it's going to have this week on the market.
Well, I mean, Netflix wasn't, it wasn't just a surprise. I mean, that was a blow up, right? I don't think.
Well, yeah, I mean, they had 100 million pirate. I mean, like they had a Netflix issue, right? 100, yeah.
Yeah, but my point is, Weiss, that I don't necessarily think you need a Netflix-like shocker for those stocks to go down. If they simply, I'm not suggesting they're even going to miss, but because they rarely do, but if the beats don't look good enough. Right, and that's been kind of the story this earnings season. As decent as the earnings, there's like a disconnect. It's the earnings. If you want to focus on the earnings and say, okay, yeah, earnings have been good, I'll give you that. But then if you partner up the stock moves with the good earnings, I'm going to say, well, therein lies the problem, because there are companies that reported really good earnings and their stocks went in the opposite direction. That's why I bring up Apple, Microsoft, and those other names, because the numbers could still be good. And the stocks can go in the opposite direction. The market can ill afford the stocks to go in the wrong direction, Weiss.
I agree with you. And so I'm hedged, not completely, but mostly hedged with either selling calls or buying puts on Microsoft, on Apple, on Amazon. I haven't done anything on Google yet. Don't know that I will. So, look, there are some times in the market where earnings matter quite a bit, and there's some times when they don't, and sometimes when they matter a little. Frankly, I think over the last few years, with money being so easy, I'm not sure earnings or fundamentals, for that matter, mattered all that much. They mattered directionally, but the focus was not on the earnings, which is why, despite Apple having basically, a couple of years of flat earnings and flat revenues, the stock still traded to almost all-time high multiple. So now you're going to have the reverse. So now these stocks, as you point out, where you've had good earnings, Cleveland Cliffs a primary example.
Like American
Stellar
Express,
quarter, stellar
right?
guide,
AXP,
stocks down.
I could go down the list. I mean, there are a lot of them.
Yep. Right. So God forbid they miss. It's look out below. But the market's already come for those stocks. So the die is cast. The market's not holding their breath, hoping for great earnings to bail them out. They're going to sell on the earnings. You might see a short-term pop, but the overall macro, the overall fear, and the bear market that we're in is going to control the direction. That's it. And the pricing umbrella, the valuation umbrella, that's gone. So now they've got to reset.
Okay, so let's do this. Let's take a quick break. We'll continue the conversation on the other side because off 52-week highs. Comm services off almost 29% off the 52-week highs. Technology was in a bear market earlier today. That's where it's trending. It was down right now 19.5%-ish from its